Austin,
What's up, man? How are you?
I'm doing good, bro. How you doing?
I'm good. I'm good. I can't complain. I'm in my Friday attire. We haven't been to
Wow.
an office. We haven't been to an office since the middle of March. So it's nice. It's nice. I'm not gonna lie. Working from home every day, it's not so bad. It's not
It's
as
a
nearly
sweet
as bad as I
change,
thought it
right?
would be. What's that?
It's a sweet change of pace, right?
Yeah, there's no commute. There's no, waking up super early to try to get a workout in. It's, oh, I can do my workout on my lunch break, and I can wake up and do some yoga in the morning and not have to wake up at 5:30 to do it. So I
Exactly.
love it, man. I love it. And I don't, honestly, I don't think it's going to change anytime soon. So I will take it. That's for sure.
Mm. What I loved about the change of pace was that it was really impressive to see so many companies that that I thought or gave us the impression that you couldn't work from home really make the adjustments during this time.
They're
So
forced
that
to.
was really cool to see because it gave a lot of
They,
people a sense of relief.
yeah, they didn't have much of a choice because you get so many companies, they didn't want to. And, whether it's just old school ownership or whatever, so
Hmm.
many people just had no interest in going down that road because they were like, well, that's going to open up a whole can of worms or whatever. Then COVID happens and there's no choice. Like you
Yeah.
have to. There's no two ways around it. Um, so it's kind of forced a lot of business owners or what have you to kind of take an uncomfortable step. But like I said, for I think a lot of people, I think they're like, oh, this actually isn't bad at all. It's the same
Yeah.
with technology where it's at. So
Exactly. It, I think a lot of people ended up being able, such as myself, really being able to see like, wow, even though with all these different shutdowns and stuff, like I'm not as affected as I think. I'm just
hmm
hearing other people be affected, but my daily routine wasn't affected much at all because I'm used to being a homebody, and so it was funny to see myself go out more intentionally
right.
because I was being told to stay in.
Right. Exactly. Yeah. You don't want to have to do what everybody else is telling you to do. I get
Yeah,
that. So, yeah, it's been good, man. I've been super lucky. Business has been really booming. Just obviously with the interest rates as low as they are for the time being. The election happens on Tuesday, and truth be
yeah.
told, who knows what's going to happen with that. So,
Well, I mean, I wanted to talk to you a little bit about that. So,
yeah,
what do the rates look like this week? I know. I mean, do they change daily or are they
yeah.
changing weekly?
Yeah, so interest rates change daily. It's based on a lot of different factors, based on the stock market, bonds, a lot of stuff that, is obviously out of our control. I'll be honest with you, a lot of times what we root for, it's going to sound weird, but what we root for is like bad stuff to happen, right? So COVID obviously is terrible, right? There's no two ways around that. Um,
Right.
but with it, it brought a lot of, investors were really freaked out and the government was really freaked out, and rightfully so, depending on where you stand or whatever. But, they wanted to inject some kind of money into the mortgage market. And so they dropped the interest rates, let a lot of people take advantage of refinancing. People that were looking to buy a home were able to take advantage of maybe having just a little bit more purchase power.
Yeah.
Um, so that was, it was a way to kind of stimulate the market for sure.
Because like a simple interest, the difference between a 2% interest and a 3%
hmm
interest on a $200,000 loan or $300,000 loan, what is
Yeah.
the difference between something like that?
Yeah. So you look at like a $200,000, loan amount, 30-year, 3% interest, 800 bucks, $850 a month. Right now, if we change that to a 2.5% interest, it's about $50. Like it's about $50 a month, right? So I mean that $50 can be the difference between somebody that's on the line, can be the difference between qualifying and not qualifying, you
Yeah,
know? And so it's been really good to see, people be able to, just kind of take advantage of everything with the markets. I think it's been a huge plus. And so I don't want to sit here and say like, we've been able to take advantage of coronavirus and COVID-19, because that's 100% not the case.
Right, right. But
it's helped us
almost
to grow and have really record numbers a lot of times.
like you were saying, the market a lot of times just depends on what is happening in society. And unfortunately, the coronavirus is something that spurred a change in the market.
Yeah, and it was the same with the government shutdown back in 2019. It was the exact same thing. The government shutdown happened, and rates. That's when they really started to go down, because they were pretty high. They were in the high fours, low fives. Right before that, government shutdown happened. All of a sudden, they started to tumble, and kind of evened out for a little bit. COVID happens, they tumble again. So it's not going to stay this way forever. Eventually the economy is going to get back on track, depending on what you believe and whatever. And you're going to see rates just start to increase naturally. So that's the big thing, is that they're not going to stay this low forever. I'm not going to sit here and tell you how long it's going to stay this way, because if that was the case, then you would see me on TV every day on, CNBC and whatnot. But
predicting the weather.
Yeah.
The mortgage weather.
Yeah. Six big screens in front of me, touch screens, all that stuff. But the election, like I said, the election's a big factor. In the past, we've seen rates increase a little bit right after the election happened in 2016. So there's always factors that play into it. And so, a lot of times I get people that are on the fence about refinancing, and, they're like, oh, I might wait. Well, you wait too long and you're out of luck,
So people who are looking to refinance and people who are looking to be financed for the first time, are they fishing for the same rates?
Not necessarily. So a lot of times it's based on different criteria. So
And what is the criteria for someone who is refinancing in this case?
Yeah, so there's two main criteria when it comes to refinancing. Number one, let's say it's just a rate and term refinance. There's two kinds of refinances. There's just a rate and term, which is just as it sounds. It's you're dropping your interest rate, you're changing your term, you're going to a 15-year, going to a 30, whatever. Just a straight up changing the terms. There's also the cash out refinance, which is taking equity out that you've already paid in. For example, got a client who is they just started, they own their home free and clear. They're refinancing, taking cash out of their property in order to pay off some student loans, right? So they have some higher interest student loans. They're taking cash out because they've already paid the home off. And so they're taking cash out to pay off those student loans. So that's an option. Now, the two things you're looking at when it comes to interest rates or pricing in general, that's kind of what I'll refer to it as pricing, is the credit score and then the loan to value. So somebody could have an 800 credit score, but if they have 10% equity, their pricing is going to look a little bit different than somebody who already has their 25%, 30% equity in the home.
Right.
So credit's important for sure, but the equity position is important too. So that comes down to an appraisal as far as that goes. So
because it sounds like, I mean, of course you can correct me, when you have more equity in the property, or when you've been paying into the property or the mortgage for multiple years, in comparison to maybe 1 year or 2 year, when you have 5 years invested into the house, you have more, it sounds like, wiggle room, I don't think is the right word, but that's the word.
There's more stability. The investors in the I say the investors, that's just an overall term. The people who kind of set the pricing, it's more stable, right? If you've got somebody who's, been in the home for 3-4 years, or has equity in that house already, then they're going to be a more stable investment. They're going to have a lot less risk than somebody who doesn't have as much equity. Really what it comes down to is, the higher interest rate just means, it's viewed as potentially a little bit higher risk, whether it's credit score, whether it's debt to income ratio, all that kind of stuff. Like for example, bank state stuff like that. That's kind of the specialty programs. Those just have a higher interest rate because there's more risk. So that's just typically what it comes down to as far as rates are concerned. It's always a big question. What's the rate? But obviously that there's more to it than just what you see as the interest rate as far as
Right.
pricing is concerned.
And so with refinancing, you're looking at the current state of the market and what the interest rates are, and if it's even going to benefit the borrower at the time. Because
it's a math
cases where it could
it's
be
a
a
math
little
question.
okay.
Yeah, it's a math question. It's will my savings be offset, or will the costs that I'm paying for this refinance be offset by the money I'm saving per month? How long does that recoup period take? Say closing costs are $3,000, $3,500, somewhere in there. You save, $100 a month, right? Let's just say $100 a month, closing costs of $3,500. It's going to take you 35 months to make up the time that you're spending on those closing costs. After month 35, you're going to have those savings every single month after that. Will you be in the home for 35 months? Yes or no? If you will, then absolutely, 100% makes sense.
Count on it.
And even if you won't, then you can structure the loan a different way. I look at my own personal refinance when I pulled the trigger on it, less than a year after closing, by the way. We started
so you were only in the house for a year until you
refinanced. We were in the house for 9 months.
Okay.
And when we started our refinance, and we knew we were only going to be here for 2 years, right? We're going to be here for 2 more years tops, and then, upgrade, what have you. And, we took a little bit, we didn't go quite as crazy with the interest rate, but we got our closing costs covered. So we didn't add anything to our loan balance, nothing. Like literally didn't add a single cent to our loan balance, but now we have a lower interest rate. Instead of dropping down a full percent, dropped a 0.5%, save that's those savings, and we're not adding anything to our loan balance because we're not going to be here long enough for that recoup. So it's very flexible when it comes to a refi, and that's the important thing.
And so is it harder to get refinanced after you got financed?
No, I think that actually makes it easier because you've been able to qualify for the house, and you were able to qualify it for purchasing. Now, I get some people who they qualified, but then all of a sudden they took out a car loan and a couple credit cards.
That's what I was going to ask you. What are some of those things you shouldn't do before you want to refinance?
Yeah, if you want to refinance, obviously the first step is to just have the lender take a look. I was speaking with somebody 2 nights ago who thought they couldn't do it because they were worried, they got all this credit card debt and stuff like that. Well, took the full application, brought in the credit report, their credit score wasn't affected, and turns out nothing to worry about. They got plenty of room in their debt to income, so on and so forth. So I don't think there's anything really you need to worry about as far as that goes. If it comes down to one where, you need to pay off some debts before closing, just like you would if it's a purchase, you just pay those outside outside of the loan transaction, and go from there. So, I don't really think there is any one, hey, don't do this if you want to refinance, other than don't put your house on the market and don't miss a payment. You know what I mean? I would say those are the 2 big ones because if you miss a payment, a lot of times you got to wait for 6 to 12 months. You miss a mortgage payment. So, forbearance, we can help you with that too. Deferral, we can help you with that. I would strongly advise you not to do that. Just word of advice. If you can make your mortgage payment, do it. Because there's a lot of stipulations that come with forbearance and deferral and all that kind of stuff. So,
yeah, I got you. Awesome. And so, tell me this. So, have some of y'all's lending requirements changed as far as the company you're with, or have lending requirements changed just federally across the board during this time?
I think they've really changed across the board. I,
in many
you
different
know,
ways, probably. I mean, of course.
yeah, yeah, in a lot of different ways. One of the first ones was the minimum credit score requirement for purchases and refinances. Um, FHA went up a little bit. Conventional pretty much stayed where it's at, but low
Tell
credit
us a
scores
little
are
bit about
usually,
FHA.
yeah. So FHA jumped to a 640. It was at, it was in the 580 to 620 range, but now it's up to a 640, and that's just full stop, right? Um, and so basically, with conventional, you can go. I've seen it. We've had an approval as low as about a 600, but it's the pricing on it isn't going to be as good. So FHA is the way you want to go if you've got a lower credit score, or not as much available for a down payment, or maybe a little bit higher debt to income ratio, stuff like that. As far as differences with COVID, that was the first one. The second one came when it comes to basically proving that you're still employed, right? So say you get somebody who is a software engineer at Dell, right?
Uh-huh.
Their salary, they're $95,000 a year, solid file, right? The biggest difference is you got to prove, usually it's, oh, they're making this, perfect. We get a verification of employment right before you close. That's it. That's good. Now it's, hey, you have to send me every single pay stub you receive from when you go under contract or when you start your refinance, whichever boat you're in, to the day that you close, because we, the lender, not Mutual of Omaha, but Fannie and Freddie, Fannie Mae, Freddie Mac, have to ensure that you are continuing to receive the same pay grade that we used to qualify you on, because maybe your company's had to scale back and now you're getting paid 80% of your salary or something like that.
Huh.
Does that take you to all of a sudden not qualifying? And so that's haven't really seen that be an issue, to be honest with you. It's just maybe it's a little bit more work for the borrower or the client. Right. But I'll be honest with you, people that are self-employed, it's tough.
Yeah.
It's really, really tough. Typically we can just go off the tax returns and kind of call it a day, but now you got to have a P&L. You got to have business bank statements. You got to prove
profit and loss.
Yeah. Yep.
Okay.
Profit and loss statement. Yep. And then you got to prove that your business is continuing to perform. If you made 50,000 in 2018, 55,000 in 2019, you got to show that you were on track to do 55,000, 60,000, whatever, in order for us to be able to even consider it. And when I say us, like I said, this is all lenders. We all play by the same set of guidelines. There's no Mutual of Omaha specific deals. But yeah, anybody that's self-employed, it's really, really tough as far as that's concerned. We've been able to get a few people done, realtors, for example, but it's a very complicated process right now, just because we've seen so many businesses close with this pandemic. So,
unfortunately,
those are the main changes.
So does the 3.5% down is still one of the main factors in the FHA loan.
3.5% down FHA. Conventional can go down to 3% based on factors. Typically starts at 5%. You can do 3%. Yeah.
So what are some of the factors to get the conventional down to 3%?
So just depends. A lot of times, if you're a first-time buyer, that helps. If a lot of it just comes down to your credit score. And that'll determine if it makes sense or not. Because obviously, the mortgage insurance can be a little bit higher with 3% as opposed to 5%. So there's a lot of factors that kind of go into it and it's really a case-by-case basis. Conventional loans, you can always go up to 97% loan to value, 3% down, same thing. Sometimes it just doesn't make the most sense though, just due to what your income is, or what your mortgage insurance would be, or what your credit is. There's never one blanket answer. Right. It's always
because there's multiple moving parts to get someone qualified.
It's never your credit score is this, your pricing is this. Oh, your income is this. That's just not the way it works.
Is there a minimum down payment?
Yeah, 3%. 3% for conventional for sure. The only true 0% down programs are USDA and VA. USDA is tough. just because it's more rural areas.
Mhm.
You know, so think like Burnett or, you know, Maine or something like that. And VA obviously is for veterans, and it's the best program out there by far.
That's where all
Um,
day, every day. Mhm.
yeah, absolutely. And we specialize in VA. And so, um, yeah, 3% is the minimum for conventional and 3.5 for FHA. There's just not really a way around it, as far as that goes.
Got you. And so, kind of in in wrapping it up, you mentioned that you all specialize in VA.
Hmm.
What are some of the things you like about the VA loan, and who specifically is it for those who don't know?
Yeah, so the VA loan is for any veteran or any active duty service member. One of the important things to keep in mind with the VA loan is that it can only be a veteran and their spouse, or a veteran and another veteran. So if, let's say I'm a vet, I'm not, my dad is. Let's use him as an example, right? My dad's a veteran. He wants to go on a VA loan, um, with my, let's say, my stepmom before they got married.
Mm-hmm.
Well, they would have had to get married before she would have been eligible to go on it with him and do 0% down,
Mm,
because it's only for the veteran and their spouse. You can
got
do
you.
VA loan with anybody that you want to, but it requires 12.5% down. And so at that point, you might as well just do like a conventional loan or something like that.
Right.
For the VA 0% down, it's for, like I said, for a veteran and their spouse. I mean, what's not to like about it? I mean, like I said, 0% down. There's no mortgage insurance, right? So there's no mortgage insurance that you have to pay each month.
And
The debt, the
the
go ahead.
more, I'm sorry about that, to cut you off. And mortgage insurance, for those who don't know, is
Yeah.
what's going to be added on to your loan when.
Mm-hmm. Yep. So the mortgage insurance is basically, it protects the lender in case of default. This was put in after the crash in 2008. You know, you had a lot of people getting in with very little money down, and those are the first people that defaulted, and all of a sudden the bank's out all this money, right? And so mortgage insurance was put in to protect the banks in case of default. And so anytime you have less than 20% down, you have mortgage insurance added to your monthly payment. And a lot of people think that mortgage insurance is the worst thing in the world. Um,
Mhm.
and they'll do anything they can to put 20% down to avoid that mortgage insurance. But
Yeah.
again, the mortgage insurance is on a sliding scale. I just locked somebody in $300,000 purchase, and 10% down, their mortgage insurance is $100 a month, right? So it's not that bad, and she's saving 30,000. She doesn't. It's $30,000 less that she's putting down, and so um, with VA, that mortgage insurance just isn't there. So 0% down, no mortgage insurance. You're typically able to qualify for a little bit more. Um, as far as that's concerned, you have a lot of protections. Say
Hmm.
your appraisal comes in low or something like that, you have an out. Um, Interest rates are lower because it's a government program. So if you are a veteran or you are an active duty member, there's not a reason to not do a VA loan. That's just what it comes down to, unless you're putting a massive amount of money down. But even then, there's no reason not to.
I feel that.
So
I feel that. Um, what are some of the ways that people can reach you?
So me personally, we have a Mutual of Omaha app that we use a lot of times. Obviously I've kind of got my own page. You can reach me through my cell. You can call me, you can email me, cell number. I can give it to you here if you want me to. I don't know if you'll kind of put a slide up with the info, or what kind of the plan is.
I'll include it in the description, but leave people maybe your social media handles or your emails.
Yeah. Yeah. So email is just my first and last name, austinfoss.mortgage@gmail.com. Or you can use my business email, which is afoss@mutualmortgage.com. Social media handles, I mean, it's Facebook. You can find me just Austin Foss. Twitter I typically use for more personal stuff, sports and more fun, not work, right? Um, but yeah, Facebook is probably where I'm most active as far as what's going on. I'm getting ready to start a short little vlog series, 5-minute posts here and there about different events. So I'd encourage you to check that out. Those are going to make their way to YouTube as well, assuming that YouTube doesn't ban me, for copyrights or whatever they want to do at this point. But yeah, those are the main ways. As far as that goes, I don't really have office hours even before all this stuff started. It's just one of those where mortgage questions, refinances, purchases, they don't happen only from 8 to 5.
Yeah.
Right. They happen. And when you want an answer, you want somebody that's going to get that answer to you no matter when it is. Mm-hmm. And that's how I perform my business. It's what people need, and they don't want, because if you have a question, it's probably pretty important because it's a mortgage. It's the biggest purchase or financial transaction you'll have in your entire life.
Yeah. If
there's something that's making you uneasy, you don't want to have to wait 12 hours until your guy or your gal gets back to the office the next day, Yeah. So that's my service and level of commitment as far as that goes.
And I could also vouch for it. I mean, anytime I've reached out to you for a question or connected you with a client or something, or just asked for like some simple update, you've always just been very transparent and available when I need you. And so that's just something that I appreciate. And that's one of the reasons that I'd like to just continue the relationship and bring you in and connect you with more people that could be in my network, because I never know who's listening or watching, but I definitely would like to act as a bridge in these cases.
Yeah, and I appreciate that. And, whenever there's questions, whether you're just wanting options and you're wanting to know the next step, that's kind of what I'm here for, is to just go over those with you, to just make it all really, really easy.
Sweet. In closing, just like 2 more things, but tell me, because I hear this so often, like, when is the best time to buy? Or I'm working on some things right now, and then I'll buy. Mm-hmm. What are the dangers of trying to pre-qualify yourself before speaking to a lender?
It's a great question. Trying to pre-qualify yourself, trying to diagnose your own perceived problems with qualifying can be dangerous. Let's say, you have issues with your credit. There's no one blanket answer for credit either. You think maybe you have too many debts. I've seen so many people that, I have this huge car loan, I need to pay that down in order to be able to qualify for more, when really it doesn't make a difference as far as their purchasing power. As far as that goes, when you talk to a lender, our whole goal is to get you approved. We don't gain anything by, going through your profile, pulling a credit report, doing all that. The credit report costs us money as a bank. And so when we're going to pull your credit report, we're going to do it with the goal of getting you approved, whether it's today, 2 months, 2 years, what have you. Yeah. And if you come in, you say, well, I'm working on A, B, and C, and then I want to get my credit pulled, or I'm working on A, B, and C, and then I'll talk to a lender. Well, what if A and B were the right things, but C put you down the wrong path? You do those 3 things, then you talk to the lender, only to find out that you could have done something different 6 months ago when you started all this, and then you would have been ready to buy then. And then that house that's on that you love right there is going to be gone because you didn't talk to the lender first. Right. If you talk to the lender first, then we're able to get you on that plan and help you determine what the best path is for you. If it makes more sense to put less down, if it makes sense to save up and put more down, have the seller pay your closing costs. You bring your own closing costs. There's a lot of different options, and trying to just read all stuff online or think about it on your own, you're really only hurting yourself, because you're not ever paying us, right? We're like a really good lawyer, or like in your sense, a really good realtor. You're not paying us for that. We don't have application fees or anything like that. So it really is just an analysis of your ability to buy, and then we're your advisor. We're not just the guy that crunches your numbers. We're your advisor to get you to the point of being ready to purchase or refinance or take that next step, whatever that looks like for you.
I like that, because one of the things I think of are factors, like you mentioned earlier, with missing a payment. With some things, you have to see a history of those things consistently, as you mentioned, like the payments, before someone is even in position to be qualified. Or there might be some circumstances where there are things you don't even look at or acknowledge, but some people might jump and pay them off using part of their down payment money. And it could have been something you told them, hey, we don't even use that as a factor.
Yeah,
And so
it's,
I
oh, I
always
have
think
all
it's
this money
important.
that I pay like on my electricity bill or something like that. It's
Yeah,
like I don't really care. It
yeah,
doesn't show up on your credit report. I don't care if you pay $700 a month for it, you know?
yeah.
So
Well, yeah,
yeah,
exactly.
trying to self-diagnose is just, it's not a good idea. It's why, I mean, it's why there's professionals out there like myself.
Exactly. So
It's just like,
remember, connect
yeah.
with Austin, y'all. Whenever you have some mortgage questions, some lending questions, stop the self-diagnosis. It is much better to speak with a lender, loan officer, a liaison in that profession. That way they could literally guide you step by step, stop sign by stop sign, and literally show you why you're doing things and why you don't need to do other things. So keep that in mind whenever you have mortgage questions. And last but not least, my man, one of my favorite questions to ask in wrapping up is the importance of a house, and the house being somewhere where, for many of us, it could be a retreat, it could be maybe our office in these circumstances, but
Yeah.
our family. It's so many different factors. But what I like to ask is, Austin, what makes a house a home to you?
Well, for us, it's a place that we can let the dogs out in the backyard. We don't have kids. We have 2 dogs. So right now, those are our children. So being able to put them in the backyard is important. But on a more, I guess, serious note,
Yeah,
it's just a place to know where I'm going to be coming home to every day. Right when I was working, it's okay. I know I'm going to be here, and every time I'm paying for that, I'm basically paying myself, because
yes,
when I go to sell this place, I know that I'm going to make that money back that I've paid. And just being able to, wake up and walk around freely in my own place, and my wife and I are able to just, not have to worry about if we're following the rules of, the apartment or the landlord or something like that. Like, we're kind of our own landlord. We don't really have to answer to anybody other than the HOA, and they're just like, hey, just, don't park a boat in your, front yard and you're fine,
yeah,
So just being able to have that level of independence, community with the neighborhood, that's the stuff that I think is the most important to me. The independence, the community, and like I said, just the knowledge that whenever we're paying our bill, because you're going to pay a bill, whether or not they're going to pay rent, even if you own your house free and clear, no mortgage, you're going to pay your taxes. Why not pay it towards yourself, right? You pay rent, you're just paying for somebody else's mortgage.
absolutely. You're helping that investor or that landlord invest
Mm-hmm.
in paying off their mortgage, when you can be following the same path in some
Yeah.
way, form, or fashion.
Your
And
home is your
that,
piggy bank. It's your home is your piggy bank. It's just the
I
way I
like
look
that. Your
at
home is your piggy bank.
it. Mm-hmm.
I like that. Sweet, man. Well, that wraps it up for today. Did you have any last words for us?
No, I would just say, like I said, you never want to self-diagnose yourself. I think that was an excellent question. Really glad you asked it. And if you have questions, just ask them. With lending,
No question is a stupid question.
no question's a stupid question. It's not your job to know the answer to these questions,
Right.
right? It's not my job to know everything a realtor knows. It's not a realtor's job to know everything I know. If somebody's in no way, shape, or form connected to this industry, they're not even going to know what questions to ask.
Yeah.
And so don't go Google it. Just ask a professional, whether it's me, the loan officer from down the road, whoever it is. It should be me, right? I'll get you the right answer.
Yeah.
But just ask, right? Just send a text, give them a call, whatever. If it's somebody that you want to be working with, then they're going to answer your question. So then just don't feel ashamed to ask questions and just learn more is what it comes down to.
Awesome. Awesome. Well, I appreciate you for today, my man. And
Yeah.
I just want to say to everybody, taking time away to reset, recenter, and realign your goals is always a great way to get yourself back on path and on track to where you're looking to grow. So continue growth and success, everybody. And this has been another episode of Inquiring Minds in our Real Estate Corner. Thank you.